The house is too big for one person now. The stairs are getting harder. The yard is more than you want on a Saturday. Sell it, they say. Buy something smaller, closer to family. Put the difference in the bank and stop worrying. They are right about the stairs. They are right about the yard. Every person who says it to you means well, and every one of them is giving you the best advice they have. What nobody in that room knows is that the tax code has 5 separate charges waiting for that decision. And here's the reason almost nobody adds them up, which is the thing I most want you to take from this. They do not arrive together. They arrive on 5 different dates. The first one lands the following April. The second one arrives 2 full years later on a Medicare statement, long after you have stopped thinking about the house. The third one never appears as a line item at all. It hides inside the arithmetic of your tax return. The fourth one vanishes at the closing table, which is exactly why nobody counts it as a cost. And the fifth one arrives every single year for the rest of your life, and it gets slightly worse each time. There is a sixth. The sixth one does not touch you at all. It lands on your children after you are gone, on money that would have been completely tax-free if you had simply stayed put. 5 dates, 1 decision. And because no 2 of them ever land in the same month, the whole thing feels free on closing day. Added together, over 5 years, it can run past $73,000. I'm going to show you every one of those numbers today on one specific woman, so you can check the arithmetic against your own situation rather than taking my word for any of it. 2 things before I start. I am not an accountant, and this is not tax advice. These are educational figures based on published rules, and your own numbers will be different in ways that matter. Anybody seriously considering this should sit down with a tax professional first, and by the end of this, you will know exactly which questions to ask them. And this is not a video telling you never to move. If the stairs are genuinely dangerous, if you need to be near somebody who can care for you, if the house has become a burden that is costing you your health, those reasons are real, and they outrank every number in this video. What I am arguing against is making this decision without knowing the price of it. My name is Kevin. I read the rules so you do not have to sit with them. And I bring them here in plain English with the arithmetic done. If that is useful, subscribe and turn on the bell, because the second cost in this video is the one that ambushes people 2 years after the fact, and there is no appeal for it. Let me introduce you to Loretta, because numbers only mean something attached to a person. Loretta is 71, and she lives alone. She spent her career teaching, and she retired 6 years ago. She bought her house in 1992 for $120,000. 3 bedrooms, quiet street, nothing remarkable. She raised her children in it and paid it off years ago. That house is now worth $520,000. She did not do that. She did not flip it or renovate it into something grand. She mowed the lawn and fixed the roof twice and lived there for 34 years while the neighborhood grew up around her. $400,000 of appreciation, none of which she went looking for. Her income is a pension of $18,000, Social Security of $22,000, and about $12,000 a year out of an individual retirement account, $52,000 in total. At that level, she pays almost nothing in federal tax. Between the standard deduction, the additional amount for being over 65, and the newer senior deduction, most of her income is wiped out before tax is calculated. The tax authority barely notices she exists. That is the situation her daughter is asking her to change. Loretta lists the house, it sells in a month at $520,000, and she buys a 2-bedroom condominium for $350,000. She believes she has just freed up $170,000. Cost number 1, capital gains. The tax authority looks at what she paid and what she sold for. $120,000 in, $520,000 out, a gain of $400,000. Now, there is a genuine and generous protection here, and I want to give it full credit because it saves most people entirely. Under Section 121 of the tax code, if the home was your primary residence for at least 2 of the last 5 years, you may exclude up to $250,000 of gain as a single person, or $500,000 as a married couple filing together. So for most people watching this, that is the end of the story. If your gain is under the threshold, there is no capital gains tax, and cost number 1 does not exist for you. Loretta is single. $250,000 of her gain disappears completely. The remaining $150,000 does not. That is a long-term capital gain, and it is taxable. Because of how the brackets work, a small portion of it falls into a 0% band, and the rest is taxed at 15%. Her bill comes to just under $20,000. Just under $20,000 on a house she lived in for 34 years, on appreciation she did nothing whatsoever to create. Now, before we move on, there is one thing here that can genuinely reduce that number, and almost nobody does it properly. Your gain is not simply sale price minus purchase price. It is sale price minus your adjusted basis, and your basis includes every capital improvement you ever made to that house. A new roof, a kitchen, a bathroom, an addition, replacement windows, a new heating or cooling system, a deck, major landscaping. Every one of those raises your basis and lowers your taxable gain, dollar for dollar. Over 34 years, that can easily add up to $60,000, $80,000, $100,000 of improvements. For somebody in Loretta's position, $100,000 of documented improvements would cut that tax bill by roughly $15,000. The catch is documentation. The tax authority does not take your word for a kitchen you remember paying for in 2004. Receipts, contracts, canceled checks, permits. So if there is any chance you will sell in the next decade, the single most valuable hour you can spend is going through whatever you have kept and building that list now, while you can still find things, rather than trying to reconstruct 3 decades from memory in the month you list. And there is a detail in that calculation that catches people, so I want to name it. In the year she sells, her income spikes so high that she loses the senior deduction entirely for that year, because it phases out above a certain income. So the sale does not only create a tax, it removes a deduction she was relying on in the same year, which makes the bill larger than the headline rate suggests. That gap between what a decision looks like and what it actually costs is exactly why the quiet rules exists. Not clever strategy, the plain arithmetic in large type, and the questions to put to a professional before anything is signed, so that a conversation at a kitchen table becomes an informed decision rather than a bill discovered the following April. Working it out beforehand takes one afternoon and costs nothing. Working it out afterward is not working it out. It is finding out. It is at kevinexplains.shop. The link is in the description below and in the pinned comment at the top. And if you are watching this on your television, there is a code on the screen you can point your phone camera at. 7-day guarantee, no argument. If it does not put something in your hands you did not already have, send it back. Cost number 2, and this is the ambush. This one does not appear on any tax return. It appears on a Medicare statement, 2 full years after the sale, when the house is long gone and the money is long spent. It is called the Income-Related Monthly Adjustment Amount. Everybody says the acronym, which is IRMA, and I will too because the full name is unbearable. Here is what it does. If your income goes above a certain line, your Medicare premiums rise. Not your coverage, your premiums. For this year, that line sits at $109,000 for a single person and $218,000 for a married couple. Loretta's normal income is around $40,000. She is nowhere near it. She has almost certainly never heard the term, but in the year she sells, her income for these purposes leaps to nearly $200,000 because the taxable portion of that gain counts. And now the part that makes this so difficult to see coming. Medicare does not use this year's income. It uses your income from 2 years ago. So a sale this year does not change anything about next year's premium. It changes the year after. By then she is 73, settled into the condominium, and the house is a memory. At her income level from the sale year, her Part B premium rises by roughly $325 a month. And there is a second surcharge on Part D, the prescription side, of another $57 or so. Together, that is around $382 a month she was not paying before. $4,584 over the year. Now the good news, and it is real, because Medicare recalculates every year, and because her income drops back to normal immediately after the sale, this lasts 1 year. It is not permanent. But she pays it, and here is the part that makes people genuinely angry when they learn it. There is a form to appeal this. It is called the SSA 44, and it exists precisely for situations where your income 2 years ago does not reflect your life today. It works. People use it successfully every day. It recognizes 8 specific life-changing events: marriage, divorce, the death of a spouse, stopping work, reducing work, loss of income-producing property through disaster, loss of pension, and an employer settlement payment. Selling your home voluntarily is not on that list. So the one situation in which a retiree's income most predictably spikes for a single year through no change in their actual circumstances is the situation with no relief available. If you stop working, you can appeal. If your spouse dies, you can appeal. If you sell the house everybody told you to sell, you pay. And there are two more features of this that make it sharper than people expect. The first is that it is a cliff rather than a slope. $1 over a threshold does not cost you a proportionate amount extra. It moves you into the entire next tier. So somebody who lands a few $100s above a line pays exactly the same surcharge as somebody $20,000 above it. Which means that in a year when you have any control over your income, and a home sale is often a year where you have some control over the timing, a small adjustment can be worth thousands. The second is that it applies per person. A married couple where both are on Medicare pay the surcharge each. So the same sale that produces one bill for a single person produces two for a couple, and the totals move accordingly. And there is a version of this worth knowing even if you never sell anything, because the same trigger fires on other things. A large withdrawal from a retirement account, a conversion to a Roth, cashing out an inherited asset. Any of those can lift you over a line for 1 year, and the consequence arrives 2 years later looking completely unconnected to what caused it. Cost number 3, and this one is genuinely invisible. More of your Social Security becomes taxable. The mechanism is something called provisional income, which is your adjusted gross income plus any tax-exempt interest plus half of your Social Security benefit. For a single person, if that figure is under $25,000, none of your Social Security is taxable. Between $25,000 and $34,000, up to half of it can be. Above $34,000, up to 85% of it can be. And here is something worth knowing regardless of whether you ever sell anything. Those two thresholds have never been adjusted for inflation, not once, since they were written in 1983 and 1993. A figure that was designed to catch wealthy retirees 4 decades ago now catches almost everybody purely because it stood still while everything else moved. Before the sale, Loretta was already above the higher line, and about $10,000 of her $22,000 benefit was taxable. After the sale, her provisional income is in the region of $190,000. She is pinned at the maximum. Now over $18,000 of that same benefit is taxable. Roughly $8,000 of additional income created out of nothing on a benefit she already paid tax on during 40 years of working. Because capital gains sit on top of ordinary income rather than pushing it upward, the extra tax on that is around $990. Small compared to the others, and I will not inflate it. But it is money taken out of a Social Security benefit that did not change by a single dollar. There is one more consequence of that spike, and it is the one people find hardest to believe. Every threshold in the tax code that depends on your income reacts at once, not sequentially, simultaneously. The Social Security calculation, the Medicare surcharge, the senior deduction phase-out, and in some cases eligibility for programs tied to income, all read the same number. So a single transaction does not produce one consequence with a knock-on effect. It produces 4 or 5 separate calculations, each run independently, each arriving at the same conclusion, which is that this person had a very good year. That is why the arithmetic feels disproportionate to people when they finally see it laid out. It is not that one thing went wrong badly. It is that one number moved and everything reading that number responded. Hettie is 68, and her husband died in February, and by June, 3 separate people had told her to sell the house. None of them meant any harm. That is what people say. It is what people have always said. Too much house, too many memories, a fresh start. What none of them knew is that a widow selling a home is in a completely different tax position from a couple selling one, and the difference is enormous. While both spouses are alive, the exclusion is $500,000. After one dies, the survivor is a single filer, and the exclusion drops to $250,000. The brackets narrow. The Medicare thresholds have. There is a provision that softens it. A surviving spouse generally has 2 years from the date of death to sell and still claim the full $500,000 exclusion. 2 years sounds generous. It is not, because nobody is thinking about capital gains at a funeral. And by the time a person is ready to make a decision that size, a great deal of that window has already gone. Nobody told Hettie the clock had started. Nobody tells anybody. And there is a second thing about her position that almost nobody explains, which actually works in her favor. When her husband died, his half of the house received a step up in basis to its value on that date. In community property states, the entire house does. So her basis today is considerably higher than the price they paid together decades ago, and her taxable gain is correspondingly smaller. Which means the arithmetic for a widow is genuinely different from the arithmetic for a couple, and different again from a single person who was never married. 3 situations, 3 completely different answers, and the advice everybody offers is identical in all 3. That is precisely what the guide is built for. The deadlines nobody mentions, written plainly and in large print, so that a 2-year window is something a family knows about in the first month rather than discovers in the 25th. And the cost of not knowing, for somebody in Hettie's position, is measured in tens of thousands of dollars on top of the worst year of her life. Same place, kevinexplains.shop. The link is in the description and in the pinned comment, and the code is on your screen if you are watching this on the television. 7-day guarantee every single time. A widow in June being told kindly to sell, with a clock running that nobody has mentioned. Cost number 4. The money that vanishes at the closing table. This one is not a tax at all. No government collects it. But it leaves, and it does not come back, and it only exists because she chose to sell. The agent's commission at 5% of $520,000 is $26,000. Closing costs, meaning title work, transfer taxes, recording fees, and the rest, run around $5,000. And the move itself, packers, movers, storage, setting up the new place, is another $5,000 for a local move, and considerably more if she goes further. $36,000. Now, somebody will fairly say those costs are simply what moving costs, and that is true. But notice what that money was doing before she spent it. It was sitting inside the value of her house, sheltered from tax, providing her with a roof every night, and costing her nothing to keep there. It is now with agents and attorneys and a moving company. It is not invested. It is not growing. It is simply left. Cost number 5, and this is the one that never stops. Property tax reassessment. Loretta has been in that house 34 years, and in most places that means she has accumulated protections. Assessment caps limit how fast the assessed value can rise each year, regardless of what the market does. Senior homestead exemptions knock a fixed amount off the taxable value. Some places freeze the bill entirely once you reach a certain age. So although her house is worth $520,000 on the market, her assessed value has been held down to something closer to $280,000. And her senior exemption takes another $60,000 off that. She is taxed on around $220,000, and her bill is a little under $4,000 a year. Then she buys the condominium for $350,000, and the county assesses it at what she just paid for it. Full current market value. There is no 34 years of accumulated caps on a property she bought last month. She may qualify for a senior exemption at the new address, and in many places there is a waiting period or a fresh application, but the base she starts from is dramatically higher. Her new bill is around $6,300. She moved into a smaller, cheaper property, and her property tax went up by more than $2,300 a year. Over 5 years, that is nearly $12,000. Over 10, it is more than $23,000, and it climbs because rates generally rise. Now, I have to be fair because some states protect against exactly this. California allows homeowners over 55 to carry their existing assessment to a new home. Florida has a similar portability feature. If you are in one of those, this cost may be reduced or eliminated entirely. A great many states have nothing of the sort. This is a question for your county assessor before you list, not after, and it is one phone call. There is a related trap here worth 30 seconds because it catches people who move to be near family. If you cross a state line, everything resets, not just the assessment, the homestead rules, the senior exemption rules, whether the state taxes retirement income at all, whether it taxes Social Security, and the estate or inheritance rules that will eventually apply to whatever you leave behind. People move from a state with no income tax to a state with one, or from a state that exempts retirement income to one that does not, and discover it in April rather than before signing. A move of 300 miles can change the tax treatment of every dollar you receive for the rest of your life. So if the move crosses a border, that is not one question for your accountant, that is 4, and they are worth asking before the house is listed rather than after the boxes are packed. Now the 6th thing, and it is the largest number in this entire video, and it does not cost Loretta a penny, it cost her children. Under federal tax law, when you die, whoever inherits your property receives it at its market value on the date of your death, rather than at what you paid for it. It is called the step-up in basis. Watch what that means here. Loretta's basis is $120,000. If she keeps the house and it is worth $520,000 when she dies, her children inherit it with a basis of $520,000. If they sell it the following week for that amount, their gain is zero. Their tax is zero. $400,000 of appreciation, 34 years of growth, erased from the tax code entirely. Not deferred, erased. But if she sells while she is alive, she pays tax on it, and that step up is gone permanently. There is no way to recover it. Her children inherit cash instead, cash that has already been reduced by tax and commission and fees. And there is a compounding effect afterward that people miss. If she invests what is left, the interest and dividends create new taxable income every year, which raises her provisional income, which makes more of her Social Security taxable, which can push her back toward the Medicare thresholds. The house generated no taxable income at all. The cash does, every year, forever. For a married couple, this gets even more striking. If both spouses simply keep the home, there is a step up when the first one dies, and another when the second one does. The entire gain passes to the next generation untaxed. 2 step-ups, no tax, on money nobody ever had to plan around. There is one more consequence of losing that step up that I want to be precise about, because people misunderstand which direction it runs. Keeping the house does not save Loretta any tax. She is dead in that scenario. The step up is worth nothing to her personally, and anybody selling you on it as a benefit to you has the arrow pointing the wrong way. What it does is decide whether $400,000 of appreciation is taxed once or never. Sell, and it is taxed once, to her, now. Hold, and it is taxed never, because the basis resets at her death, and the gain simply ceases to exist as far as the tax code is concerned. So this is not a question about her retirement. It is a question about what she wants the house to have been for. And that is genuinely a values question rather than a tax one, which is why I am not going to answer it for anybody. Some people want the money now, and that is entirely legitimate, but it deserves to be a decision rather than an accident. So let me put the whole thing together. Capital gains, just under $20,000. The Medicare surcharge for 1 year, about $4,600. Additional tax on Social Security, around $1,000. Transaction costs, $36,000. Additional property tax over 5 years, nearly $12,000. Just under $73,000 over 5 years from one decision that felt like it freed up money. And now I am going to argue against myself for a minute, because you deserve the other side properly. Downsizing genuinely does save money. A smaller condominium costs less to heat and cool, less to insure, and vastly less to maintain than a 34-year-old house with a roof that will need replacing. Those savings are real, and they can offset $2,000 or $3,000 a year, which over 5 years takes a meaningful bite out of that total. Some of those costs are also one-time events rather than ongoing ones. The Medicare surcharge lasts a year. The capital gains tax happens once. And there are reasons to move that have nothing to do with money at all. Being near a daughter who can drive you to appointments is worth more than any figure in this video. Being unable to manage stairs safely is not a tax question. There is also a cost on the other side of the ledger that never appears in anybody's spreadsheet. 34 years in one place means a pharmacist who knows your medications, a doctor 7 minutes away, neighbors who notice when the curtains stay shut. Isolation is one of the most serious health risks in later life, and leaving a community you have been inside for 3 decades is a real cost, even though nobody can price it. So this is not arithmetic that decides the question for you. It is arithmetic that belongs in the question. And there is one alternative worth naming, because a lot of people selling are really only trying to reach some of the equity rather than leave the house. A home equity line of credit lets you borrow against the value of your home without selling it. Borrowed money is not income. It does not appear on your tax return. It does not raise your provisional income. It does not touch your Social Security taxation, and it does not trigger the Medicare surcharge. It has genuine risks and genuine costs, including interest payments and the fact that the house secures the loan. It is not right for everybody, and I am not recommending it, but it is a path to some of the money that avoids all 5 of the costs in this video, and a great many people have never had it explained to them as an option. One more thing before my read on it, and it applies to anybody thinking about timing. These 5 costs are not all fixed. Some of them respond to when you sell rather than whether. A sale that closes in January rather than December moves the entire tax event into a different year, which changes which year's income determines the Medicare surcharge and gives you 12 extra months to arrange everything else around it. If you are planning a large withdrawal from a retirement account, doing it in the same year as the sale stacks 2 spikes into one number. Splitting them across 2 years may keep both under a threshold that either one alone would have crossed. And for anybody near a Medicare line, the question is not only how much the gain is, it is whether a slightly different closing date puts the whole thing on the correct side of a cliff. None of that is exotic, and none of it requires an aggressive accountant. It requires knowing the levers exist before the house is under contract, because afterward there are no levers left. So where do I come out on this? What strikes me is not any single cost, it is the timing. And I think the timing is the whole reason this happens to people. If the entire $73,000 arrived on closing day, on one statement, nobody would sign. It would be obvious. Instead, it arrives in April, then 2 years later on a Medicare notice, then invisibly inside a tax calculation, then quietly at a closing table where it looks like a normal fee, then every year forever in an envelope from a county. By the time each piece lands, the decision that caused it is old news. Nothing about that is anybody's design. It is just that the tax code, Medicare, and your county have never had any reason to speak to one another. And the only place all 5 of those things meet is inside one person's life. And the person who pays for that is never a wealthy one. It is somebody living on $52,000 a year who looked like a high earner for exactly 12 months. So here is what to actually do. And there are 3 things, and none of them require you to decide anything yet. First, work out your gain before you speak to a single agent. Current value minus what you paid. Then, and this is the part people skip, add up every major improvement you have ever made. A roof, a kitchen, a bathroom, an addition, windows, a heating system, major landscaping. Every one of those raises your cost basis and lowers your taxable gain. If your gain after improvements is under $250,000 single or $500,000 married, cost number 1 does not apply to you at all. And this video just got a great deal cheaper. Second, work out your income in the sale year and compare it to $109,000 single or $218,000 married. If the sale pushes you over, you have a Medicare surcharge coming 2 years later, there is no appeal for it, and the only way to avoid it is not to trigger it. Ask your tax professional to model that specifically, using those words. Third, ask about the step-up in basis and about your own state. Ask what the difference is between selling now and holding, and ring your county assessor and ask one question. If I buy another home in this county, does my current assessment transfer? That answer alone can move the total by $20,000. Loretta was told by everyone who loved her to do something none of them had priced. Hettie was told in June, 4 months after burying her husband, with a 2-year clock already running that nobody mentioned. Both of them were careful with money their whole lives. Neither of them was given the full picture, because the full picture does not sit in any one place, and nobody whose job it is to know volunteers it. And if you are in the middle of this decision right now and cannot work out which of these apply to you, email me. The address is on your screen and in the description below. I read every one that comes in. So take the afternoon, your gain, your improvements, your income, one call to the assessor. Then decide whatever you want to decide, with all of it in front of you rather than a third of it. I am Kevin. Thanks for watching. Do not forget to check the quiet rules at kevinexplains.shop.